Hello everyone, this is Steve Elwell, the Chief Investment Officer of Level Financial Advisors, and this is your third quarter market recap. The stock and bond markets around the world continued to struggle in the third quarter of 2022, with the U.S. market down about 4.5%. International stocks down even more than that as the U.S. dollar rallied strongly over the third quarter. And the bond market continued to struggle as the Federal Reserve was very aggressive in raising interest rates. And all of these movements in the stock and bond markets are a big picture result of what's happening with inflation and the Federal Reserve and raising interest rates. I mean, for the year now, the global stock market is down more than 25% through the end of September. And the U.S. bond market is down 14.5% through the end of September. So it, by all measures, a difficult year when it comes to how the investment markets have performed so far. Having said that, let's talk about the moving pieces of what's causing this downturn, what the markets are thinking and digesting, and what they're concerned about. And like I mentioned before, the main topic of the day when it comes to market moving news is what's happening with inflation. Here's a chart from JP Morgan that shows inflation, different aspects of it: headline inflation, core inflation. There's kind of a couple of different measures that the Federal Reserve looks at when they decide what it is they're going to do with interest rates. But when we look at the past charts that show how inflation looks, you can see back in the 70s, the hyperinflation we had then. You can see some of the wild changes that happened with deflation back in 2008. But specifically, I want to draw your attention to the right side of this chart that really ends up showing how inflation has spiked since the latter part of the pandemic, really starting in 2021. And accelerating, but also highlight, both with the blue line and the gray line here, that it appears that inflation may have peaked over the summer, and we might be starting to get some reprieve, specifically in headline inflation. In fact, we have another chart here from our friends over at Dimensional that show some of the moving pieces of the commodities market, which of course is made up of a lot of different things. But how did they perform in the third quarter, which, like I said, is really kind of what looks like so far the peak of inflation and some of the pullback that has happened. We mentioned a little bit of this in the quarterly letter, but this is sort of another way to visualize it. Natural gas had a great quarter, along with corn and wheat and live cattle did okay for the quarter. But when you start looking at other things like coffee, silver, gold, aluminum, all sorts of different things related to oil, cotton, unleaded gas, which of course is a major one for all of us that are driving our cars everywhere. We're seeing some pretty major declines over the third quarter. And it'll be interesting to see when that information starts to reflect in the inflation reports. How much does that move the needle? Does that give the Federal Reserve reason to slow down or pause their interest rate increases? They have another meeting here in November and another one in December, in which they've indicated they intend to raise rates at both of those. We'll see just how much they end up doing, if any at all, depending on what some of this inflation data looks like going forward here for the next couple of months. But there is hope that if inflation truly has peaked and is starting to retreat and come back down closer to a more normal level, there is hope that the Federal Reserve will be able to take their foot off the pedal and slow down what they're doing when it comes to interest rates and increasing those interest rates, which have really been the difficult thing for the markets to handle. There's been such a fast speed of how they've raised interest rates that that's been sort of a lot for the markets to digest so far this year. And rightfully so. There's some concern about, well, what will that mean for the economy? And so let's look at that. We have another chart here from our friends at JP Morgan that shows basically the last 20 years of economic growth via this gray line. We can see the downturn in 2008. We see the drama of what happened in the spring and summer of 2020 when, basically we shut down the economy and then turned it back on. But the trend line is very clear. I mean, sometimes when people ask me, how is it possible that the stock market, has this level of growth over the last 20 years that it's had? And this is a pretty obvious chart. I mean, the economy has grown fairly steadily over that 20-year period. There's been some bumps in the road for sure. But obviously, as the economy grows, then, one would hope that corporations, which are the driver of that, are creating more goods and services and selling them and having profits as a result of that. That's kind of the U.S. economic engine here. But when we look at the very edge, the upper right edge of that chart, then we can see a little bit of a level off here in the U.S. economy, a slight downturn. First quarter GDP was negative 1.6%. Second quarter GDP was negative 0.6%. A normal quarter might look like something between 2 and 3%. So year over year, the economy has still grown, but for the first and second quarter, it's been slightly negative. Now, normally that's kind of the 2 quarters in a row of negative GDP contraction would be defined as a recession, but they have not yet called a technical recession. There are other factors, including what happens in the job market, which has remained very robust, which is probably why they have not called a technical recession yet, because the job market, is so good right now. But if you're someone who is saying, oh, the investment markets are down because the economy is going to fall off of a cliff, we haven't seen that yet. The data doesn't show that. Obviously the future is unknowable in the short term, but the data does not yet reflect that there's some huge downturn that's happening in the U.S. economy, not in the first quarter, not in the second quarter. Now, how long does it take for these interest rate increases to potentially start to impact that? One would think, given that they started the interest rate increases in March and really ramped up over May and June, one would think that we're going to, start to see that in some of the data if it's true that it was going to slow down the economy in a major way, which is certainly no guarantee. The U.S. economy certainly might be strong enough to withstand this level of interest rate increases. That's what we're going to find out. That's part of the reason why the markets were worried about it, why they've gone down, is because there are investors that are worried that there's going to be a slowdown. But even as we look at this next chart from JP Morgan that is showing some of the consensus estimates of corporate profits, when we look at this chart on the left side, which shows how corporate profits have grown over the years, and the gray lines represent growth. The green lines are technically what would be called an earnings recession, where corporate profits were still good but went down from the previous year or from the previous reading. If we're looking on the far right side of that, number one, corporate profits look pretty good for 2021 and 2022 is looking to be similar to 2021. And 2023 and 2024 are still expected to grow. So generally, when you're talking about the investment stock market going down, you're talking about, in theory, the worry that corporate profits are going down. The consensus so far, which is no guarantee, it's just simply how all the analysts view what the future might look like. The consensus so far is not expecting an earnings recession. And so what we're really kind of looking at, the chart on the right here shows a similar thing. If you look at the gray line, represents earnings growth, which year to date has been 5.1% positive. So corporate profits have grown so far here in 2022, but yet the stock market's gone down. And that's a reflection of what the stock market thinks maybe the future might hold. But don't get me wrong, the stock market has predicted the future incorrectly a ton of times. The stock market tends to overreact to just about everything. The old joke on Wall Street was the stock market had predicted 9 of the previous 5 recessions. Obviously the joke is it's predicting a recession all the time, regularly, and sometimes it's right and sometimes it's wrong. But so far this year, corporate profit-wise, there has not been, some huge contraction that has happened. So from an economic standpoint, from a corporate profit standpoint, the data just doesn't show that some huge negative shift is happening here in the U.S. I think it really remains an inflation story, an interest rate story, where the markets kind of say, well, we don't know how big of an impact this is going to be, but clearly some investors have decided to exit and not wait and see sort of what happens. When we think about how will this downturn play out, we remain as confident as ever that this stock market will recover at some point. We don't know how fast that will happen. Often the recovery between a recession and a downturn start to finish, the average is slightly less than 2 years. This has already started. I would argue that the peak was back in the fall of 2021, but technically for the S&P 500, the peak high was early January of 2022. But when I think about, well, if from an investment perspective, we know that our best bet is to stick with our investment strategy, to rebalance the portfolio as needed, take advantage of any tax savings opportunities that we have, but specifically to stick with the game plan, because the only way we get hurt is if we get out of our seat and try to time the market, which we know we can't do and no one else can do. No one has ever done successfully, regularly throughout different investment markets. Some people have gotten lucky certain times, sure, but no one has consistently been able to do that. And it's a difficult game to play, considering you have to be right twice. You have to sell before markets go down, and then you have to buy back in at a lower price before markets go up. The first part is a little easier than the second part, because of course if you get the first part right and you correctly exit as markets after you sell go down, your theory is reinforced. You get even more confident in your theory that the markets will continue to go down, and having the ability to buy at a lower price doesn't ever end up happening. People end up sort of getting stuck at that moment. And then the markets do start their recovery, and you don't believe that it's going to hold, and it does, and then it moves higher than the price you sold at, and now you're really backwards on your game plan. And as the market marches forward, you just feel worse and worse and worse because you didn't get back in time. But if you're someone who believes that at some point this will recover, and I want to show this chart again from JP Morgan because we showed it last quarter, often we end up saying when markets go down, your expectation for future returns should go up. And that feels counterintuitive. Markets are going down, and my expectations for future returns should be higher. That feels odd. But knowing that U.S. stock market and global stock markets have recovered from every downturn that's happened in the last 100 years and moved forward above and beyond that, partially because of that economic chart we showed earlier, that the slow chug of the economic engine of the world continues to gradually improve every single day. That's the reason, many of us go to work every day, right? To get a little bit better, to cut costs and reduce costs for whatever product or service we're creating, to try and create a better product or service every single day. That's the whole point of what everybody that's going to work is trying to do. And if you're someone who believes that it's going to recover, this chart shows that return-wise now, because the third quarter was also negative, that now to recover, the numbers are even bigger than what they were last quarter. If you think the market's going to recover in 1 year, then it's going to need a 35% return to do that. If it's going to take 2 years, then it's going to need a 38% return. When we start looking at the average returns over this time frame, that's when it really gets actually kind of interesting. Over a 2-year period, that would be an annualized return of 17.6% per year. 3 years would be 12, 4 years would be 9.4, and 5 years would be 7.9. So let's backtrack here. Hold on a second. The average downturn has taken a little less than 2 years from top to bottom to sort of work its way through and recover. If we're looking at a 2-year time frame just from this moment, which would be longer than average, considering that we're already, like I said, 9 months in here, a little longer. If we're talking about the market recovering in the next 2 years, then there's about to be 17% annualized returns in the S&P 500. If someone told you that, you would be excited about the future. You wouldn't be feeling negative. You wouldn't be feeling pessimistic if someone told you that's what the thought might be. So, if you're one to remain that this will eventually recover, which we have no reason to believe that it would not, particularly because this is somewhat of a self-inflicted slowdown, is what I would call it, knowing that the Federal Reserve actively is choosing to raise interest rates aggressively on one of the fastest paces ever to try and stamp out inflation, and presuming that they're successful. If they do stamp out inflation and then pause, then in theory that should build the foundation for the recovery for the stock market to take hold. Obviously, we can't guarantee that, but clearly the main driver of this year's market volatility has been inflation and the Fed raising rates. So of course, if inflation goes back to somewhat of a normal number and the Fed stops raising rates, well, what is the reason now for pessimism about the U.S. economy that appears to even be chugging its way through this already? The one other thing, there are actually two other things that we would like to comment on, and it's not just the stock market potential for future returns if this does recover, which is important, but also to not forget, and we mentioned this again also in the quarterly letter because it's such a big change, is what has happened in the bond market. So bond interest rates, because the Federal Reserve has raised interest rates, bond interest rates have gone up dramatically. This is a chart that shows the yield curve. The gray line represents what the yield curve looked like on December 31st, 2021. And this blue line represents September 30th, 2022, so only 9 months later. And I specifically want you to pay attention not so much to the long-term bonds. I mean, don't get me wrong, the 20-year bond going from about 2% to 4% is good news, but the real change is on the short end. Previously a 1-year bond would be paying, back at the beginning of the year, something like 0.4% a year, and now it's paying over 4% per year. I mean, that's an enormous move in the amount of interest that's collected on short-term bonds. And so short-term bonds now are earning so much more interest than what they were earlier in the year. That, for retirees and savers like our clients, is excellent news that now we're going to earn some real interest. Yes, it was a little painful to get there as the Federal Reserve changed rates so fast that it caused even short-term bonds to lose some of their value. But knowing that now we're going to collect this much more interest, if an investor can simply hold on and actually collect that interest, that not only will they be repaid for the decline that happened in the value of their short-term bonds, but once they're repaid for that, all the higher interest they earn after that will just be icing on the cake. They will be now earning, like I said, something in the range of 4.25% interest on short-term bonds that used to be earning 1.25% interest. I mean, 4 times more interest than what they were before is a big move, and that means the expectations for bond returns going forward are much, much, much better than what they were at the beginning of the year, even knowing what we know now. So yields going up for bonds is a good thing, particularly for short-term bond investors like us and our clients. In the intermediate term and long term, this is really good news that interest rates have gone up to finally collect some interest on that side of the portfolio. And one final thing that we would want to add, let me add a little other piece to the bond piece. It's not just short-term bonds where the yields have really moved forward, but also on the corporate bond side and municipal bond side, that yields have really, yield effectively just being the amount of interest that you collect, have really gone up quite dramatically. So beyond U.S. government bonds, investment grade corporate bonds are now even earning something close to like 6%. High yield bonds are over 9%, according to this JP Morgan chart here, as of September 30th. Municipal bonds are paying substantial amounts. So on the bond side, things have actually, it's been painful to get there, but they actually have improved, and the expectation for future returns on the bond side have really improved. The last thing that I want to highlight here, we get a lot of questions at this time of the year about the elections. We have midterm elections coming in November. What effect might they have on the investment markets? How should we position our portfolio if this party wins or that party wins or takes over control of the Senate or the House, both of which seem to be in play this year? And the bottom line ends up being, as much as it feels like it shouldn't be true, is that the economic engine of the U.S. economy and the global economy and the stock market, to be frank, they don't really care. It doesn't seem like that should be true. And maybe in one given day there could be some movement that happens based on this or based on that. But the long-term effect, and this chart from DFA highlights it, is there is no clear pattern that's a result of, if this party's in control, that's good news for the markets. Or that party's in control, it's good news. Or mixed control is always best. There is no clear pattern of any of that. And we've seen that, just over and over and over again. We heard a million predictions about the 2016 presidential election and the impact that might have one way or another. And the consensus, was, if this person won or that person won, the markets were going to drop. And then the election was over and the markets rallied strongly. And I would argue that it wasn't a result of who won, it was a result of it's over. And now we can go back to worrying about what the markets really worry about, which is the economy growing? How's the job market doing? And most importantly, what do corporate profits look like? That's always going to be the bottom line with the stock market. So I would not let the upcoming elections drive any investment decisions that you're making with the portfolio. When you think about, should I make a change, or does something need to be reviewed based on who we think is going to win what? There's just no clear pattern when it comes to that. So we wanted to just kind of recap these different points when it comes to how the third quarter played out, how inflation is looking, why there's some reason for optimism on that front, how bond yields going up is actually good news for future expected returns. So we're going to enjoy collecting certainly more interest. We've already seen it and continue to see it grow month to month. And then just a reminder that the elections upcoming are certainly important and everyone should get out and vote. But from an investment perspective, we don't expect it to have any clear discernible pattern about how we should do or invest one way or another. And so with that, I want to thank everybody for joining for the third quarter market recap. I'm Steve Elwell, Chief Investment Officer at Level Financial Advisors, and we'll talk to you next quarter.